is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Shares fall in Credit Suisse after longtime investor Harris Associates sells its remaining stake, piling more pressure on the troubled Swiss lender. China sets a full-year growth target of around 5%, coming in below economists' expectations. Metals and crude oil decline. Plus, has London actually lost its appeal as a top destination for investment? We'll discuss that in our exclusive interview with the chairman of Natwest, Sir Howard Davies. Now, first thing is first, let's check in on the markets. A couple of things that we need to look out for. First of all, global markets pretty much steady when it comes to stocks. I think the big question is what happens to Treasury yields. Would they extend the decline that we saw last week? And, of course, as we continue looking at National People's Congress over in China, we'll have more clues on what kind of growth they're expecting. I know we're seeing quite a lot of pressure on commodities on the back of that 5% growth target, which was a touch below what economists were expecting. European stocks for the moment gaining 0.3%. S&P futures practically unchanged. And then a bit of pressure because of that expectation of China growth for crude oil down 0.7%. Now, let's also look. We are bracing for a lot of course, strikes in France over the week. So let's also see if there's a difference between what the UK is doing. There was a pretty explosive interview in the FT from the Shell chief executive saying, look, the UK needs to do much more to become as investable as the US. A bit of pressure on the FTSE 100 there, down 0.1%, the CAC 40, but also the FTSE MIB gaining some 0.6%. Now, shares in Credit Suisse are trading lower after the Swiss bank's biggest shareholder for many years, Harris Associates, sold its entire stake. Harris Associates Deputy Chairman David Harrow shared his view with Bloomberg last year.
This has been a problem child. We've owned this bank literally since the early 2001. And the first 10 years was a very good holding. I mean, it literally went from 20 to 60 or 70. Now, what we should have done is just sold it and that's it.
Well, joining us for more is Bloomberg's finance reporter, Marion Halftermeyer, who is on top, of course, Credit Suisse and breaks more news than anyone else. Investors, Marion, good morning, are definitely not happy.
No, they're not happy. And as you saw in that clip, actually, you know, David Harrow of Harris Associates had actually been a longtime supporter of Credit Suisse. And we saw that support start to erode over the last couple of years as the bank was just hit with scandal after scandal and was losing a lot of money. And that was a great interview, Francine, from last August, where David Harrow was saying, you know, they need to really fix this money-losing investment bank. Now, the ironic part is that they did actually do what some of the things he was calling for. They've decided to spin out that investment bank. But it seems to be that it's just not going to be enough, and maybe it's a little too late and too costly at this point, so they've given up.
So what supporters do they have left?
So they've got the Saudi National Bank. They came in as a new big supporter. They've almost got a 10% stake now. They came in with the capital raise last year. And then they also still have the QIA, which have been longtime supporters since the financial crisis.
What does it mean for, what does the bank need to do at this point to actually reset its business? And Marion, if you think about it, I mean, without going into philosophy, I mean, it's really difficult for the bank to attract new shareholders if everyone else is doing better because of higher interest rates.
It is a difficult spot. It's a difficult year to be doing a turnaround. And the whole situation is complicated further by the fact that they have not only this complicated carve out of an investment bank, which has rarely been done in history before, not at this size and scale. And then also on the flip side, they're trying to keep their wealth business healthy and profitable. And that's been really difficult as we've seen just massive outflows on that side of the business. So it's really hard to get investors interested in Credit Suisse turnaround story right now, particularly because they're not going to be profitable for another year or two from now.
Marion, thank you so much, as always, for your great reporting. Bloomberg's finance reporter covering, of course, Credit Suisse from Zurich, Marion Halftermeyer. Now, China's National People's Congress has agreed also to set a modest economic growth target of around 5% for the year, avoiding any large stimulus to spur consumer-driven recovery already underway. Let's bring in our Chief Asia Economics Correspondent, Enda Curran. Enda, good morning. So what exactly is the significance of this policy?
Well, it suggests a fairly modest tone on the stimulus front for China. Francine, like you mentioned, the targets come in at around 5%. Some economists were talking about 5.5%. They're also talking about creating 12 million urban jobs this year, keeping the unemployment rate, the surveyed jobless rate, at around 5.5%. So it's kind of a broad message of steady as she goes for the economy, certainly hosing down any expectations for massive kind of stimulus that we've seen in previous China downturns. The expectation is the target will be hit well because the consumer spirits and business sentiment has improved with the end of COVID zero. The second half of the year might be more difficult, however, and that's where the government support will kick in. But more broadly beyond that, the NPC is also going to be critical to see what personnel get what jobs, and of course that will play a role in shaping the narrative for China's economy in the years ahead.
So, Enda, what has been the messaging actually on technology from China's NPC?
Well, we had, through the state media today, we had messaging from President Xi Jinping making the point that China is going to double down on high-end manufacturing. This is all about cutting China's reliance on the US and elsewhere for the kind of technology it needs to turn itself into a tech kind of superpower. So there's no hint of a U-turn on that. And of course, it puts itself on a collision course with the US at a time when the US is forcing through export controls and other restrictions. So that messaging on developing its own technology will surely add to the ongoing tensions with the US.
Enda, thank you so much. Enda Curran there, of course, on the very latest on China. Now let's get straight to the Bloomberg First Word News. Here's Samuel Etienne. Hi, Etienne.
Good morning, Francine. Bloomberg has learned the White House is close to completing an executive order that would limit some investments by US companies in China. The restrictions are said to include advanced technologies that could enhance China's military and intelligence capabilities. UN negotiators have agreed the wording for a new international treaty that adds protections for almost 2/3 of the global ocean. The agreement is a culmination of almost 2 decades of work and seeks to end the unregulated exploitation of the high seas. If delegates formally adopt the text, it will go to the UN General Assembly for approval. And Estonia's Prime Minister Kaja Kallas has secured a commanding election victory, fending off a challenge from the far right. Her Reform Party took around 31.5% of the votes, with counting almost complete. Under Kallas, Estonia has been one of the most strident critics of Moscow, supplying Kyiv with more weapons than any other country on a per capita basis. And the new CEO of Shell has told the Times newspaper that Britain is less attractive as an investment destination because it's failing to match green energy subsidies. Well, Sawan says the UK should take a page from some of the things that the US have done recently. He also criticised the shifting tax regime and the government's energy windfall tax. And that's Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg. Francine.
Thank you so much, Samuel Etienne here in London. Now, coming up, as global markets react to China's 5% economic growth target, we speak to Sir Howard Davies, the Natwest Chairman. That exclusive conversation is up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, let's return to one of our top stories this hour. China has set a modest economic growth target of around 5% for the year. It suggests less of a boost to the already struggling world economy. Well, joining us now for an exclusive conversation is the Natwest Chairman. He is Sir Howard Davies. Sir Howard, thank you for joining us. We'll talk about banking. We'll talk about the UK economy. But first of all, over the weekend, we were really trying to follow what was going on in China. A lot of economists saying, look, 5% is just not strong enough. From a UK perspective, how much does the UK need a strong Chinese economy?
We benefit somewhat indirectly from China because, unfortunately, the UK does not export anything like as much to China as, say, the Germans do. So in Germany, it's big news because of the exports of cars and heavy equipment. For us, it's more indirect because our actual direct trade volumes are relatively modest. So it's not great news, but I don't think we'd been expecting much more, frankly. And 5% that's actually delivered would be better than a sort of bogus 8.
Yeah, which they can't deliver on.
That's right.
talk to me, if you look at the pitfalls for, the inflation, I mean, you're one of our smartest thinkers on everything from banking to inflation to how central banks, deal with it. Are you confident about the world economy?
I'm not. I'm confident that the economy is a bit better than we thought. I mean, we've said for a while that we thought the UK economy would be broadly flat this year rather than the recession that the Bank of England was forecasting. And so far, touch wood, we're looking as though we probably were right about that. But I'm quite pessimistic on inflation. I think that inflation has become, in this economy, somewhat more embedded than we wanted. And inflation expectations are now higher. And I think it's going to be very hard to get inflation back down close to the Bank of England's target.
So do you think the Bank of England will have to be very, very aggressive in trying to regain control? Are we close to seeing actually a wage spiral? Or do you think they'll leave it at 3-4% without worrying about it too much?
I fear they're going to have to do more than they are currently saying. But the big question, and you can see people starting to discuss this, a very interesting article by Andy Haldane, who was the chief economist in the Financial Times over the weekend, as to whether really getting down to 2% next year is actually feasible, or we should think about saying, well, we're not going to try to get there in one go. We're going to maybe get to 3 or 4% and then look at it again. That personally would be my favoured route, because I think if they really do try to get to 2 next year, then it's going to be unpleasant.
I mean, unpleasant as in they'd have to crush the economy.
I think they would have to raise rates quite a bit, and in order to get down to that, you've got to change expectations, and changing expectations is tough once you've allowed them to become unanchored. And so I think the output cost of getting there would be high.
I think 4 or 5 months ago, we were talking about, zombie companies and the fact that it's amazing how fast the Bank of England was able to raise interest rates without many companies going bust. Are you still uneasy? Like, I know there's a lag time of how the monetary policy works, but are you uneasy about nothing ugly having happened?
Well, that hasn't changed, and we keep expecting that there'll be more bad debts in the corporate sector, but we aren't seeing them yet. And it does seem that companies did build up deposits through the COVID period. They are running them down, but slowly. And so there is quite a cushion still there for companies. So, no, we're not yet seeing the kind of wave of bad debts that we thought we might see. And I think that's true of the other UK banks.
But could they never come? Or at some point, is it going to be, reckoning time?
I think in some sectors they probably will come, because you probably have got preserved some companies whose business models are no longer appropriate for the new world, and they were sort of set in aspic pre-COVID. But at the moment, I have to say, we're not particularly pessimistic about the UK corporate sector at this point.
Sir Howard, talking about mortgages, again, I know there's a big wall of mortgages, up for refinancing, I think, middle of next year. Do you worry about some of the stress?
Well, it's not enormously, because we used to stress our mortgages at 7%. So, in other words, if you came for a mortgage with us when fixed rates were 1.5% or 2%, we would say, OK, well, Francine, can you cope if interest rates are 7%? And we'd go through your finances with you and see if you were OK at that. So we're not expecting, since we haven't got above to there, we're only about 4% at the moment, we're not expecting a lot of people to be in absolute distress unless unemployment rises, because that is the key thing. If unemployment stays relatively low, employment rates stay relatively high, then we're not so fussed about it. People won't like it because, of course, they'll have less money to spend on other things. That won't be great for the economy. But we don't expect a lot of mortgage defaults.
But the 7% stress test does also factor in, inflation at 10% for energy and other goods.
Well, I mean, the honest answer to that is no, it didn't. So people's finances will be a bit more stressed than it looked as though it was. But there's quite a gap there. So I'm not expecting big defaults. As I say, people will find their disposable income squeezed, and they're going to find that squeezed through inflation. But that's a different thing.
All right, Sir Howard, stay there, because I know we have, I have many, many questions to ask you about France versus London, or Paris versus London, and, of course, how investable the UK is. We're back with Sir Howard Davies, Natwest Chair, very shortly. Coming up, we'll talk about the UK, discuss the City of London's investment appeal in a post-Brexit world. More on that next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now let's continue our exclusive conversation with the Natwest Chair, Sir Howard Davies. Sir Howard, thank you so much, first of all, for staying with us. When you look at a lot of bankers, and this was, I think the latest was Citigroup, a lot of bankers having to move to Paris. I remember you explaining also with data about how some of the high-earning banks and bankers had to move because of Brexit. What does a Windsor framework mean now for bank moves?
I don't think that will make much difference at all, actually, because the key thing is what the European Union does on things like euro clearing, and that's in their hands, not in ours. They're finding it very difficult to persuade people to shift their euro clearing into the eurozone because London is more efficient and a deeper, more liquid market. But I doubt if the Edinburgh reforms will make any difference to those moves. But they're not on a massive scale, I have to say, so far. I mean, if you look at the numbers, you see the big winners have been Dublin and Luxembourg, and to some extent Paris. We've increased our numbers in Paris, but to some extent by consolidating from elsewhere in Europe, actually.
Is the UK investable? So we've had a couple of chief executives speaking to various press saying, look, in terms of green technology, the UK should be more like the US. Other chief executives saying they should be more like the EU. Where are we on investability of the UK right now?
Well, I mean, I guess you have to look sector by sector. As far as the energy sector is concerned, I think we do have to listen carefully to what people like Shell are saying because, you know, that's their perception. I couldn't really countermand that, if you like, from a banking perspective. As far as finance is concerned, then I think that London used to be the onshore financial centre of Europe, really, as well as the offshore financial centre. And now I think we're becoming the offshore financial centre of Europe. So European companies looking to raise funds in the Far East and in the US, etc., London is still the centre, but we're no longer well positioned to intermediate intra-European flows. I think that's the shift that's going on.
Is there anything that the UK can do in terms of regulation to attract more of these IPOs? I think they lost out twice last week.
To IPOs, yeah, is a different matter. I mean, I think that's more to do with investment demand in the UK. And what we've seen is a long period during which the UK institutions have reduced their holdings of UK equities. Now, I think we might hope, and here one of the reforms is relevant. I think the Solvency II reforms should make long-term institutions here, should give them a higher appetite for UK equities in the long run. So that could be helpful. But unfortunately, you know, New York did win on technology stocks. And so any technology stock, I think, finds a more ready home in New York with analysts and investors more willing, more understanding of their business model. And so there has been a bit of a bifurcation, and that's not helped us because it's been tech stocks that have been growing more rapidly.
But has that changed? And actually, is there a danger that this also hits other sectors, that, you know, gradually London is just seen as less of a good place to be IPO'd or listed in?
Well, it could do. I think we need to try hard to stop that. And I think the reforms proposed by Jonathan Hill, I'm not sure this has anything to do with the Edinburgh reforms exactly, but Jonathan Hill did a very good report about the ways in which London could be made a more interesting market for IPOs, and I think those are worth pursuing.
Is there anything that you would do more immediately, actually?
I'm not sure that you can turn this tap on with just a single regulatory reform, frankly. I mean, some of the reforms on two-tier stocks and things like that and voting rights are probably worth doing at the margin, and so they would make some kind of difference. But I fear we're talking very long-term trends here.
Is there something that the Chancellor can do more immediately in the budget to, you know, if not have a huge impact, at least be perceived as more investor-friendly?
Yes, I think the big problem the Chancellor has got is that with the changes in corporation tax, which has been a bit of a push-me-pull-you thing, with, you know, rates supposedly going down, then going back up, and investment allowances going up and then going down, I think he probably does need to tweak that, because otherwise I think it is going to look as if the UK is running against the rest of the world, and the UK is not very attractive from a corporation tax point of view. Now, he hasn't got as much room for manoeuvre as some people are suggesting, given the medium-term fiscal prospects, but I think something on investment allowances would be sensible.
Sir Howard, thank you so much, as always, for giving us a little bit of your busy schedule. That was Sir Howard Davies, the Natwest Chairman. Now, we'll be covering all things UK every week on Thursdays at 9:30 a.m. in our half-an-hour special. Also coming up, the former Treasury Secretary, Larry Summers, says the Fed is behind the curve again. We'll speak to Greg Peters of PGIM, fixed income on Fed, China, and his outlook. And then we have to talk coffee with Andrea Illy. We'll talk about a possible IPO, and we'll talk, of course, about the price of Arabica beans. This is Bloomberg. Shares fall in Credit Suisse after longtime investor Harris Associates sells its remaining estate piling, more pressure on the troubled Swiss lender. Well, China sets a full-year growth target of around 5%, coming in below economists' expectations. Metals and crude oil decline, plus San Francisco Fed President Mary Daly says U.S. rates are likely to be higher for longer. The chair, Jay Powell, heads to Capitol Hill on Tuesday. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Fed Chair Jay Powell set to deliver his two-day biannual monetary policy testimony on Capitol Hill tomorrow. He's expected to echo fellow central bankers in suggesting that interest rates will go higher than anticipated. Well, the former Treasury Secretary Larry Summers says that the Fed is behind the curve again. He spoke with Bloomberg's David Weston.
The Fed right now should have the door wide open to a 50 basis point move in March. No need to be committed to that till we see the next employment figures, till one sees what happens in markets. But if markets are now saying 22%, that means the door isn't open to that possibility. And there's a very significant chance that that's going to be the right thing to do.
Well, joining us now is Greg Peters. He's Managing Director and Co-Chief Investment Officer of PGIM at Fixed Income. So, Greg, thank you so much for joining us. It does seem, if you look at actually fixed income and some of the wild swings that we saw in treasuries and just in general yields, including high yield, like what's the new regime looking like for fixed income?
Well, I think fixed income is just following the data like the Fed. So everyone's proclaiming the Fed should do this, they should do 25, they should do 50, but we're all just beholden to the data releases. And fixed income is just following along. What I think is interesting, though, is that the fixed income market continues to be very inverted from a yield curve perspective. So you have this higher for longer in the front end, and then you have this, pricing in a recession, at least, to a certain degree in the back end. And at the same time, you've had a very solid backdrop for risk assets. And so those two things really don't comport.
But, Greg, the market is basically trying to figure out what the Fed does, but we need to figure out what inflation does. How do you expect inflation to behave in the next 6 to 7 months?
So I think the lesson learned and relearned over the past 2 years is that inflation is really difficult to forecast, right? So the forecast error around that function is extremely high. At the same time, we do think it's coming down, but the real question is, where does it land? So you're seeing, the wage pressure side is the key because it's hard to get service inflation lower when wages are so strong and the labor market's so strong. So that's really the key. So it's almost more about labor than it is inflation.
But how's it possible? And I understand that monetary policy has a laggard, maybe to 12 to 18 months, that, a former policy member reminded this of us last week. But how's it possible that employment is still so strong, given how much we've hiked?
It is befuddling to many. And I don't think anyone really forecasted such a high level of rates with such a strong kind of labor resiliency. At the same time, though, a lot of the areas of the labor market are just recovering from pre-pandemic. So if you look at some of the service areas around hospitality, that's still below where it was. So it's a very interesting labor market for sure. But at some point, we don't know what the level is, but at some point, we're pretty certain that higher rates will lead to a weaker employment market.
Greg, do you know when that is? And again, we're talking about the consumer, continuing to spend. How much of this is a legacy of COVID, of savings that they had put in place that they're now burning through?
So I think what's been missed is the strength in the nominal growth, right? So everyone's been focused on real GDP, but when you're coming off of very high nominal growth, which is where we're coming off of, it's still reasonably high. That means there's an underlying strength, underlying spending, and I think it just takes longer for that to shake out of the system. So the Fed, I believe, central banks globally will hike until something breaks, and we're just not there yet.
How much imagination do you think central banks and the Fed especially will have? So will they stick to the 2% target? Will they, live with inflation of the 3 to 4% because otherwise they'll have to crush the economy? Or will they just, delay the communication when they'll touch 2%?
Well, I'm hoping they're not overly dogmatic, but I think 3.5 to 4 is too high.
Yeah.
I think in the 2% area is actually okay, but it's an open question. Everything's an open question, right? But I think the worry is that once you lose control around inflation, it's hard to get it back. And the Fed knows this, and they're a student of history, and they don't want to be on the wrong side of history here.
So 2023, how much volatility in bonds? I mean, I feel like this is the year of fixed income to, the good or the bad side.
No, I still think it's the year of fixed income. So I do think bonds are back. Yields are higher, often negative, zero rates. These are all very positive items for sure. But there's still a lot of work to do, and volatility will be here for a while. But we're coming off of a much higher yield level, so it covers a lot more mistakes.
So, Greg, what are you buying right now? If you look at your ideal portfolio, let's say 2 months from now, and then longer term to the end of the year, is it different?
It is. So I think it's too early to go deep in risk, deep cyclical type of investments. We see a lot of value in structured products. We see a lot of value actually in the front end. You're getting a lot of carry. So we think it's a market to take what's given to you, and there's a lot being given. And so it's not a place to go into triple C's, levered loans, all these types of areas. It's a much safer environment for bonds, and we're just taking the carry and roll.
I don't know how you look at the inverted yield curve. I have at least one or two viewers every day that send me a good chart on this. Like, what do you think it shows us?
Well, what it shows me is that something needs to be reconciled this year, and I think that's the source of volatility. You can't have an inverted yield curve and expect risk assets to do well. So what I worry about in terms of 2023 is actually we achieve this soft landing and the curve starts to normalize, and that's the catalyst for the slowdown, because there's so much borrowing off the intermediate to back end of the curve that could actually be the hit to consumers, that could be the hit to corporations ultimately. So it bears watching, no pun intended.
It certainly does bear watching. Greg, I mean, so we had the new China data, or certainly growth forecast, which some economists say, look, it's disappointing, but I guess there's a better chance of them actually hitting it. Does that change your strategy, or at least your thinking longer term, of how much China can contribute to the U.S. economy?
Well, so what I think what's being missed here is the secular shift. The past 10, 15, 20 years where China was the driver of global growth, that is no longer the case. And so I think what you'll see during this whole economic maturation process of China is just less and less growth into the global system. And that matters a lot. So I don't think we're going to have the same kind of fueling of China into the global system. And this is just a reflection of that reality. So 5 years forward, 10 years forward, it's just going to be less and less and less, and that matters globally.
But they've also been talking about creating a parallel system, right? So this affects how much treasuries they buy, but also I don't know whether there's petro yuan that we need to worry about, or China's reserve currency like renminbi.
Well, so I think you're bringing into this whole geopolitical aspect, which I think will also assert itself. As China starts to slow, that geopolitical piece becomes more important and more prevalent and more pronounced, actually. So I think, unfortunately, this is the world that we live in. The risk that we really haven't worried about in the past 10 years is really heightened here around geopolitics. And I think it means you need extra risk premium as a result.
Greg, how much time do you spend thinking about Japan? This is probably the most exciting moment for the country in at least a decade.
Yeah, well, more, I'd say. Yeah, so, I mean, speaking of regime shifts, so, end of the Kuroda era, but it's an open question as well. Yeah. So will rates move higher? Maybe a little, not a lot, but I think, Japan is very much stuck to a large degree. But I think the bottom line, whether it's Japan, U.S., Europe, is that higher rates, all else equal, are better, right? They're better for savers, pension funds, and the like. And so I think we're in a much more natural world, a much more natural state of investing. I think that's all good.
But Greg, when you speak to investors or your clients, do they ask you about Europe? Do they ask you about Japan, or do they just pound you with Fed questions?
Well, well, the Fed is definitely the #1 question, but it is a global marketplace, and there is a revisitation of global investing, right? When in the U.S. And in Japan, with rates at such low levels, it really forced investors outside those jurisdictions. So what I think you'll see over the course of the next year or so is just continued kind of repatriation of funds back to kind of the home bias, right? So I think that all needs to kind of settle and shake out.
Well, not dull. Greg,
not dull at all.
Thank you so much for joining us. Greg Peters, our Managing Director and Co-Chief Investment Officer of PGIM Fixed Income. Now, in the last couple of minutes, we also have some breaking news out of China. We understand through the Wall Street Journal that China is poised to create a news government agency to actually centralize the management of the country's store of data. Again, we've been looking at their relationship with technology and data gathering. We understand through the Wall Street Journal that the News National Data Bureau is expected to become the main Chinese regulators on various data-related issues. And then multiple ministries had shared the oversight, and we understand this is probably centralized. The latest news coming out of the National People's Congress. Coming up, we talk coffee. Andrea Illy, the chairman of Illy Café, joins us to discuss consumer confidence in a cost of living crisis and, of course, the future of the coffee industry. That interview in just a couple of minutes, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Samuel Etienne. Hi, Sam.
Hi, Francine. Italy's state lender CDP says it's teaming up with Australian infrastructure fund Macquarie on a bid for Telecom Italia's landline network. The offer counters one last month from US investment firm KKR. Both bids are said to value the Italian asset in a range of 18 to 20 billion euros, including debt and some performance-based earnout. SoftBank-backed UK chip designer Arm is reportedly seeking to raise at least $8 billion in a US IPO. Reuters says Arm is expected to confidentially submit paperwork for its listing in late April. Bloomberg earlier reported that bankers had pitched a wide valuation window of between $30 and $70 billion for the company. The new CEO of Shell has told the Times newspaper that Britain is less attractive as an investment destination because it's failing to match green energy subsidies. Well, Sawan says the UK should take a page from some of the things that the US has done recently. He also criticised the shifting tax regime and said the government's energy windfall tax. Tesla has cut the prices of its Model S sedan and Model X SUV in the US for a second time this year. Tesla sells its cars direct to consumers and often tweaks its pricing. The latest moves come even though Tesla drastically cut prices in January in a broad bid to boost sales. That's global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg.
Etienne, thank you so much. Now, coming up, the chairman of Illy Café, Andrea Illy, joins us to discuss the outlook on coffee, my favorite subject, and the consumer trends to watch this year. That conversation is up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get to another exclusive conversation, probably with one of my favorite subjects. With interest rates heading higher and the soaring cost of living biting, what's the outlook for discretionary consumer spending? We're talking coffee. I'm very pleased to be joined by Andrea Illy, the chairman of Illy Café. Thank you so much, Andrea, for joining us. I have to disclaim that coffee, especially in a newsroom that wakes up at 3 in the morning, is more of a national obsession. How do you see our consumption of coffee changing through lockdown into the next 2-3 years?
Well, coffee, we always drink coffee. No good time, bad time, coffee is always there. Because with good time, you celebrate, and with bad time, you encourage yourself. It's good for the dynamics, the, professional and social life. So consumption is always
stable. So you're not worried about the trend, but do we consume coffee differently than we used to?
A little bit more at home,
yeah.
Because thanks to, smart working, people maybe go less often to office, and they stay home and they consume more at home, so they're seeking for better homes, well equipped with coffee machines, portionate systems. So we used to be 60% out of home and 40 at home. Now it's, during COVID, has been reverted. Now it's 50-50, and we think we will stay there.
So, Andrea, where's your biggest area of growth? First of all, when you look at, I imagine that it's different because you have many more Italian coffee shops in Italy that people, drink at the bar very quickly, that the composition of how much you sell in bars compared to at home is different, for example, in the UK, in Italy, or in the US.
Well, super premium Italian espresso is growing internationally because it's also leading, it's a kind of a driver for growth for premium coffee as well altogether. This interesting decommoditization of coffee from a pure functional beverage to an experiential one is really so dynamic. And this is why we export more and more. More than 2/3 of our sales are now internationally in 147 countries.
Right.
So we are definitely the most global coffee brand. Yeah. And there is so much room for growth. For the future.
Yeah, so first of all, this is exactly what I need at 5 in the morning, a super premium Italian espresso. Is there a danger that if you become too big, you become less luxurious, so you lose a bit of that super premium aspect?
It is still a niche brand, and we want to stay niche. The demand is growing, so that means that even though maybe the niche becomes the same, the market is growing because the demand for premium coffee is growing. Yeah. And as far as diluting, let's say, the brand equity, I don't see this as a problem. And for sure, we will never compromise on quality. I'm coming back from Brazil now, where I'm constantly working with growers in order to improve their sustainable quality and also create the offer for production for the future is ahead.
So what do you make, and we've been looking actually at the price of coffee beans quite intensely, especially in preparation for this interview. Robusta coffee has rallied in terms of prices. What's the impact of that?
Prices of coffee are now volatile. There is a volatility which is now not driven any longer by the shortage of supply, which was 2 years ago as a consequence of this frost in Brazil. Now production is expected to be at least in balance with consumption, but because we don't have a clear figure about how much will be the production, still there is a little bit of volatility. So I predict this price to stabilize during 2023.
But if you look at Arabica, so if the price of Robusta, I mean, look at me, I'm like an expert in coffee, right? You have Robusta and Arabica. If Robusta, the coffee prices go up quite significantly, is it less likely that companies will blend it with the better Arabica?
Hopefully, yes, even though we don't deal with Robusta altogether.
So you don't blend?
Super premium coffee is only Arabica. So typically there is an arbitrage. So but the other way around, when Arabica is too expensive, some roasters, they use a little bit of more Robusta in order to mitigate the price increase.
Andrea, how's the expansion in the U.S. going? Are you getting business? Are you where you want to be, or is there going to be a lot more expansion?
We are where we want to be. It's our second largest market after Italy. We seek for the U.S. to become medium, long-term the first market altogether. So we are investing in distribution, we are in product development. We are on target, and still we will improve our, let's say, penetration in the years ahead.
Will you IPO? I ask you this every time. We ask the chief executive every time.
It's in the plan. We now have a co-investor, Round Capital, with a 20% share. And the plan is that their exit will be within 5 years or 7 years with an IPO.
So are you waiting for like ideal market conditions, or is there, in your mind, when does the IPO happen?
Preparing the company, preparing a nice equity story. And so we hired a new CEO, Christina Scocchia, who took position last year. She already did a first year quite good. And now we are in the process of really preparing the equity story.
Andrea, talk to me a little bit about China and the fact that it's reopening quite significantly. Does that impact does it impact Italy, or does it impact the price of coffee beans?
It's not impacting really our performance, because we used to sell a lot of coffee during the lockdown period at home. So China is growing double digits. It's a promising market, also because there is more and more, let's say, cultural cross-fertilizations are getting these Western lifestyle habits, which is, of course, good for coffee. And we keep growing.
Yeah, I'm sweating because we're going to have a coffee afterwards, Andrea, in our pantry at Bloomberg. So I hope it's to the high quality. You were also telling me, actually, that when did we invent coffee or start drinking coffee? In what, the medieval times?
In Europe, continental Europe, we started drinking coffee around the half of the 17th centuries. And the good news is that it took modernity, because before coffee, people were drinking beer for sanitary reasons, because there was alcohol. So from 3-4 beers per day to 3-4 coffee, this is why we got enlightened, and not accidentally. It started the Illuminism, the Cultural Revolution, Scientific Revolution, all the modern trends, which created the society we are accustomed to now.
But now, I love that. Beer, from beer to coffee, certainly, I'm sure, made people a little bit more aware of, certainly, the news out there. Are people drinking less coffee but higher quality coffee now?
No, they typically don't drink less coffee, also because there is a kind of self-adjusting dosage. Okay. With higher coffee means higher quality, means lower caffeine. So this is why people have two incentives to drink more, because they can have more caffeine, and more flavor. Okay,
there you go. Sponsored by Andrea Illy. Thank you so much. I'm not even going to ask you about Starbucks, I think, putting olive oil in their coffees, because I know then you need to be sedated. That was Andrea Illy, the chairman of Illy Cafe. Now, coming up, we have an exclusive conversation with the chairman and chief executive officer of JP Chase, Jamie Dimon. He sits down with an exclusive conversation with Ed Hammond. This is Bloomberg.
We're on this long road, and we are not necessarily knowing where the end of that road is going to be.
My view is that we're going to see a slowdown in the U.S. economy in the next few months, and it will be significant. I think in many sectors we're already seeing it.
It doesn't appear as if the consumer is increasingly confident in their financial footing.
There's still a lot of excess buffers in financial markets and among households.
We still like banks because valuation is supportive. Balance sheets are supportive.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Credit Suisse loses one of its biggest backers. David Herro of Harris Associates sells the firm's entire stake in the embattled Swiss bank. Citigroup plans to almost double its staff in Paris. The expansion comes as Citi and its rivals continue to grapple with life after Brexit. And China sets a cautious growth target. That's likely to mean a smaller boost for an ailing global economy. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, I read with interest that there are 13 days ahead of us, which will be key for the direction of markets for the rest of this year. We're going to get jobs data, Powell speaking, a Fed rate decision, CPI out of the US, lots of things to watch out for.
Yes. as usual, the days ahead are important to the future of market prices. Let's take a look at what's going on right now in terms of U.S. pricing. Futures going a whole lot of nowhere. S&P futures unchanged. I noticed that NASDAQ futures were up a little bit. Dow futures were down a little bit. But basically, the idea is that the markets are paused now as they assess what China's weaker growth goal means. Obviously, it won't spur global growth as much as it would have. However, it's not going to spur inflation in that case either. So we have to decide if this is a good thing or a bad thing. And we're going to talk about those goals and the MPC. The U.S. 10-year yield is coming down 2.5 basis points, but still at a relatively high level, close to 4% at 392.64. It is not 4%, though, so we raised over that level for really the entirety of the curve last week. Now we've come back down. That's good news for stocks as we continue to come down. Yields offer less of a headwind to equities. Crude is off a little bit, but $79.12 is a relatively high price, especially considering the fact that you have lower expectations for Chinese growth. Does that mean that Chinese consumers are going to be tanking up less often? It certainly doesn't look that way. It's not reflected in this price. Unless this is a demand issue. It's interesting to see WTI trading so close to 80. And then Bitcoin right now down, holding around the $22,000 level, but it's incrementally fallen over the last few sessions from basically 25 grand to 22 right now. Take a look at Asian markets. They're up in terms of the broader market. The Asia Pacific is up 0.7%. The Hang Seng is a big gainer as well. You can see it gaining, not a big gainer. It's in positive territory, even with these lower growth targets. You see it gaining about 0.2% right now. The Nikkei is up, closed in Japan over 1%. So the bigger gains in Japan than we see in China. And right now, the U.S. dollar strengthening a bit against the yen at 136.07. Anna, what do you see in Europe?
Yeah, Matt, what we see in Europe is a kind of mixed picture, actually. If we look at the sector breakdown, 2/3 of sectors are in positive territory, and the Stock 600 is just in positive territory. So we are seeing moves a little bit higher, and we're benefiting from some of the read across out of China in some senses, not on basic resource stocks. Those are weaker. We've seen iron ore coming down, copper coming down as a result of that. Modest growth target in a Chinese context, of course, around 5% coming through from the MPC. So that's weighing on mining stocks in London, which is hurting the London market. The consumer products and services sector, though, is doing pretty well. This and travel and leisure. And there does seem to be an expectation that perhaps the domestically driven, consumer-driven part of the Chinese economy is where the future is going to be, less so manufacturing, even though this is, of course, still a massive manufacturing economy. But that's what a lot of guests have been talking about today. And interesting in that context to see that some of the consumer products luxury names in Paris move higher. Brent crude, the other side of that story, in keeping with what we're seeing on basic resource stocks, we're seeing Brent crude come down as oil prices are retreating. Matt's just been through some of this detail with regards to China and expectations for growth there. Telecom Italia up by 2.9%. We've been talking for decades about the best way to structure ownership of some of the infrastructure around the telecom sector, and this is to do with landline networks. We're now seeing a big bidding battle. KKR going up against Macquarie in tandem with an Italian state-backed lender, and so they're competing for the landline assets at Telecom Italia. We'll keep an eye on that deal. And Credit Suisse in focus, down by 1.2% today. This after we've heard at the weekend that a big shareholder then, who's been at Credit Suisse for 2 decades at least, Matt, has decided to sell his stake.
Yeah, huge news. I was honestly a little bit shocked when I read that. David Harrow is the shareholder. He shared his view on Credit Suisse with Bloomberg last August.
This has been a problem child. We've owned this bank literally since the early 2001. And the first 10 years was a very good holding. I mean, it literally went from 20 to 60 or 70. Now, what we should have done is just sold it and that's it.
Joining us now for more from Zurich is Bloomberg's finance reporter, Marion Halftermeyer. Marion, investors clearly disappointed with this, one of the biggest backers bowing out.
Yes, exactly, Matt. This is a big deal. They've been, as you've heard David Harrow say himself, they've been with the bank for a long time, and they really stuck through with this bank after a couple years of scandals and lacking profitability and huge losses. And ironically, they had been calling for a solution that stopped the investment bank from losing money for the broader bank. And the bank did do that. They said, okay, you know what, we're going to carve out this investment bank into CS First Boston. Now, what we understand is that, Harris Associates has said, you know what, we're going to sell out anyway because the plan you've presented us is too cumbersome, too complicated, and eating too much capital that it's just not worth it for us to stick by you anymore.
Right, so that was the verdict, and they don't mince their words. Certainly, in some of the language to the FT over the weekend. Now, what supporters does Credit Suisse still have left, then, Marion? Are we looking here at the Middle East?
Exactly. So the main shareholder, so who has replaced Harris Associates, is the Saudi National Bank. They participated in the capital raise last year, and so they've now got about a 10% stake. So they're quite supportive. And then you can't forget about QIA, Qatar Investment Authority, that has also been with the bank for the last decade or so. And they continue to hold a significant stake and continue to support the bank in their plans and restructuring.
All right, we're going to continue to obviously follow this story, not only Credit Suisse, but what happens with First Boston. Marion, you got a great story out on the terminal about their Goldman Sachs-like partner structure as well. So we will follow the evolution of Credit Suisse as we watch also UBS. Marion Halftermeyer, thanks very much for that. UBS, as I mentioned, cutting employee bonuses for last year by 10% to a $3.3 billion slump. $1 billion after a slump, I should say, in mergers and capital raisings. Meanwhile, the CEO, Ralph Hamers, gets a bump. So cutting bonuses for the lower ranks, but giving the CEO more money. Great story. And in Paris, Citigroup, speaking of banks, or sticking with banks, I should say, is building a new trading floor as the Wall Street giant prepares to nearly double its staff in the French capital. Joining us now is Bloomberg finance reporter Jennifer Serrain. So, Jenny, what is Citi doing in Paris? Why ramping up now?
Yeah, it's really all tied to Brexit and the fact that they are still needing to put more and more traders and their risk books back out on the continent. So you see them adding traders, support staff, different operations folks, and they're looking to bring their staff in Paris up from about 130 to 250 in the coming years.
Okay, and we're hearing a lot more and more about companies choosing to beef up operations outside of London. This is a Paris story. We hear them in Frankfurt, in Dublin, in Amsterdam. What does this mean then for London's status as a hub for finance and commerce?
Yeah, I really don't think it's a winner-take-all. So I think, London still is as a main hub for Citigroup and other banks, and there's still thousands and thousands of employees here. But you will see this continued move out, especially as these banks slowly convince workers and really come to grips with these different regulations. You're going to see more folks in Paris, Frankfurt, Dublin, Milan. But London, London is London.
All right, Jenny, thanks very much. Jenny Serrain there reporting on some of the moves out of the city into Paris. Let's get to China, though. The big story maybe behind markets this morning. It has set a modest economic growth target, suggesting that there will be less of a boost to an ailing world economy. Beijing's goal for GDP growth this year is around 5%, modest for it. Economists had expected a more ambitious target following a rebound in consumer spending and industrial output following the reopening, basically, and the reversal of COVID-0. Enda Curran, our chief Asia economics correspondent, joins us now. So is this bad news for the global economy? And I was listening to Christian Muller-Glissman at Goldman Sachs this morning, who said there's good news here as well. It won't be driving inflation.
Well, look, it's probably, at the very least, an attempt to manage expectations on the Chinese side. A lot of economists were talking about 5.5% for a growth target. That's probably where Wall Street was. But the officials have come out with 5%. And the thinking is that target should be hit pretty easily, Matt, because of the pickup in consumer and business sentiment on the back of COVID-0 coming to an end. We've already had better data to kick off the year. Remember, last year China missed its growth target by a long mile. Growth came in at 3%. It had targeted 5.5%. It's setting 5% this year. So that's being seen as something of a floor, an achievable target, and an attempt by the authorities just to manage expectations for stimulus.
Okay, and what has been the messaging then on technology from China's MPC? Because the growth target was one thing that caught everybody's eye, but also a lot of big names in Chinese technology waiting to see what the regulatory environment looks like and whether they actually get their seats on the MPC still.
Yeah, well, the tech tycoons got a cold shoulder at the Congress, so to speak, but certainly the broad message around development and development ambitions to turn China into a technology superhouse, I mean, that seems to be a central focus of these meetings. We had commentary from President Xi Jinping today through the state media doubling down on this idea that China has to move now to the next leg of its manufacturing development. And essentially that's code for it has to stand on its own 2 feet in the technology space. It cannot rely on the US, for example. Hardly a week goes by now without getting news of US export controls on key critical technology into China. China is now responding, trying to ensure that it can develop on its own 2 feet. And that seems to be the message coming from the NPC, that they are going to double down on that. And that's why we'll expect to see a lot more focus on development, I think, over the coming years.
All right, Enda, thanks very much. Bloomberg's Enda Curran, they are chief economics correspondent in Asia, taking a look at what's going on in China in terms of its growth target. Let's take a look at some of the stocks we're watching in the pre-market here in the U.S. this morning. Shares of Hertz Global Holdings are gaining after Barron's recommended buying the warrants as a good alternative to the stock. Nonetheless, investors are pushing the price of the underlying shares up in the pre-market. Also, watch shares in Tesla after the EV maker slashed prices on some of its most expensive models. Yes, again, this isn't the same old story. I think it's $5,000 on the Model S, $10,000 on the Model X, this in the U.S., and Jefferies also raised its price target on the stock to $230 from $180. Clearly, they've surpassed the former target. And watch U.S.-listed Chinese stocks after Bloomberg reported that the Biden administration is nearing a completion of an executive order that would restrict U.S. investments in China's technological advances, a move that risks dampening the already fraught relationship between the two countries. Anna?
Matt, coming up on the program, we will talk about the global economy. Nobel Laureate Michael Spence joins us. He has thoughts on the post-pandemic global economy. We'll get to that conversation shortly. And JP Morgan Chairman and CEO Jamie Dimon sits down with Bloomberg's Ed Hammond for an exclusive interview later today. That's live today at 11:40 a.m. New York time, 4:40 in London. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. We are looking at market pricing right now of a terminal rate of 5.43%. That would be the effective rate, meaning that the Fed would be raising to as high as 5.5%. You can see that the Fed's median dot was for 5.25%. Okay, the effective rate of 5.1%. We're going to use a whole bunch of different kinds of Fed funds pricing here. But the bottom line is the market is now going higher than the Fed had in its dot plot. And of course, Fed speakers have said they may need to raise rates higher for longer. Ven Ram joins us now, Bloomberg's cross-asset strategist, to talk about what exactly this means. Ven, does the Fed definitely go now to 5.5%? Is there a chance they push up to 6%?
Morning, Matt. I do think that there is a chance that they may raise it to 6%. And a lot will depend on what this week's non-farm payrolls data show. Of course, the consensus is that, we are not going to get anywhere near the outsized print that we got for January, but still the expectations are that we'll get a pretty robust number. If we get that robust number, and if hourly earnings growth is pretty strong, and if the jobless rate is ticking around 3.4, 3.6, that's not going to bring the labor market into equilibrium. As we know, the Fed thinks that the labor market will get into equilibrium at 4.6% jobless rate. We are far off from those levels. So the Fed has to willy-nilly keep going higher. And that means 550 is a chance, and so is 6% a chance, definitely.
OK, so that's how high we could go. Then, do we need to, where are market expectations versus what the Fed is telling us at the moment then? I mean, I ask this because we're going to be hearing from the Fed. We'll hear from Jay Powell this week, won't we? Larry Summers, ahead of this appearance on Capitol Hill by Powell, has been suggesting that perhaps the Fed chair needs to open the door, in his words, to 50 basis points, making it clear that rates could step up as well as having stepped down previously. Is that a door that you think should be opened, is likely to be opened?
I don't think that's a door that the Fed is going to open the door to a 50 basis point hike, simply because they've stepped down to a 25 basis point hike. Now, if they go ahead and raise it by 50 basis points, the signaling to the market and to the economy will be very negative, because they will think that the message that will be sent out to the markets is that the Fed is panicking in the last lap of the inflation push, and therefore they're losing control of inflation, and the markets will panic, and it will cause an adverse feedback loop in the market, which the Fed will be mindful of. And therefore, I don't think the 50 basis point option is anymore on the table. They will keep going at 25 basis points. And they are thinking the labor market will cool sooner or later. And those tech layoffs that we saw earlier on will feed through probably from March, April. So that's what they're waiting for. So there is no urgency in the sense. So they will keep going at 25 basis points.
Ben, I recall reading a story, I think 2 weeks ago, about how global investors were preparing for the downturn of the dollar. Clearly, when we look at the Bloomberg Dollar Index, when we look at global markets, that hasn't happened. What's your expectation for the greenback?
I think the greenback will stay supported around current levels, simply because the Fed is going to keep going, as we just discussed. But the key engine for higher dollar is predicated on real rates. And if you look at real rates in the US, whether the 5-year rate or the 10-year rate, they haven't really pushed meaningfully higher than we were at the start of the year. So at the moment, the dollar is going to tread water around current levels. It's not going to go to the peaks that we saw last year on the Dixie, for instance, to 114 levels. I don't think that's on the cards.
Then can I ask you about what's going on at the European Central Bank? There does seem to be a debate happening right now. Markets increasingly factoring in, pricing in higher rates in the Eurozone. Is that because they're just factoring in what they think the ECB is going to do? Or is it because they think that the ECB will hike and regardless will have higher inflation? What do you think is being acted on here?
I think there are two factors that the market is cognizant of now. The ECB turns out much more hawkish than even what we were thinking about 1 month ago. And that's the consistent signal from the ECB. And the latest inflationary trends that we've got from the Eurozone don't give any credence to the fact that, the ECB estimates that inflation this year is going to be, HICP inflation is going to be 6.3%. Looking at the latest trends, we don't get the impression that it's going to converge to even 6.3%. So we are at 250 on the ECB deposit rate. So that means that the real policy rate is deeply, deeply negative. And in this environment of extraordinary inflation, to have deeply negative rates means that the ECB will have to work harder to control inflation, and which is why the markets are thinking they need to perhaps push to even 4%.
OK, Ben, thank you very much. Thanks to Ben Ram of the Bloomberg Markets Live team. For more market analysis, you can check out the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
Now, keeping you up to date with news from around the world, here's the first word. Ukraine says that Russian forces are trying to cut off the besieged city of Bakhmut. The Russian attack is preventing Ukrainian troops from reaching residents who want to evacuate. Still, analysts at the U.S.-based Institute for the Study of War say the Russians will probably not be able to encircle Bakhmut anytime soon. There's been a breakthrough in a long-standing feud between Japan and South Korea. The South Korean government says it would resolve a dispute over people forced to work for Japanese companies during Japan's colonization of the Korean peninsula. The conflict had disrupted relations on everything from trade to security. A second Norfolk Southern train derailment in Ohio within a month has Congress calling for rail safety legislation. Saturday's derailment happened outside Springfield, Ohio. That's about 180 miles west of East Palestine, where a derailment spilled toxic chemicals last month. The CEO of Norfolk Southern will be questioned Thursday when he testifies before a Senate committee. And U.S. lawmakers are stepping up the push to ban TikTok. Senate Intelligence Committee Chairman Mark Warner plans to introduce a bill this week to allow the U.S. to systematically ban Chinese technology, including ByteDance's popular video service. One of the top concerns is that TikTok keeps American data.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Credit Suisse loses one of its biggest backers. David Harrow of Harris Associates sells the firm's entire stake in the embattled Swiss bank. Citigroup plans to almost double its staff in Paris. The expansion comes as Citi and its rivals continue to grapple with life after Brexit. And China sets a cautious growth target. That's likely to mean a smaller boost for an ailing global economy. I'm Anna Edwards in London with Matt Miller in New York. And Matt, as we look out across the week, we're going to hear from Jerome Powell, of course. The jobs report, clearly the data point of the week, though.
Yeah, the jobs report is the data point of the week, but that comes at the end of the week. So to kick off the week, I think a lot of us are focused on the Chinese economy and the goal that the Chinese have set for themselves in terms of economic growth. 5% in our terms sounds like a lot. It's pretty tepid in Chinese terms. And the question is, are you concerned that they're not going to be the engine of the global economy the way we would have expected, the way they were pre-pandemic, or are you happy that they're not going to be boosting inflation and central banks around the world aren't going to have to keep raising rates to quash it? Right now, S&P futures are pretty undecided. Absolutely nothing going on after the gain we had last week in the cash trade in futures to kick off the week. We do have rates coming down a little bit. Remember, we were up over 4% on the 10-year, really across the curve. Now we're down 9 basis points from that at 391.27. So that at least is a tailwind for stocks this morning. NYMEX crude remains pretty high. For WTI to see a figure close to $80 a barrel is a lot higher than what we've seen over the past few weeks. We've been looking at a 74, 75 handle. Now we're looking at $79 a barrel for West Texas Intermediate. And then Bitcoin remains relatively low in terms of the range over the past couple of weeks, because we had approached 25 and we're holding there for quite a long time. Now we're back down at 22,390. In terms of the pre-market, I mentioned Hertz this morning because Barron's had a piece out on Friday about a strategy involving buying warrants. They said it's a better alternative than buying the stock. Nonetheless, investors have pushed up the price of the underlying shares. Right now, Hertz Global Holdings up almost 5% in the pre-market. Watch shares of Tesla. There has been a lot of back and forth. They cut prices, then they raised prices. Now they're cutting prices again on the most expensive models in the U.S. $5,000 now off on the Model S, $10,000 now off on the Model X. Of course, these are aging designs, and maybe they have a whole lot, well, certainly they have a whole lot of margin baked in there, so they can afford to do this. The stock not quite reacting in the pre-market. We'll watch it at the open, 198 for Tesla. I should also point out Jefferies has raised its price target on Tesla to 230 from 180. Apple right now up about 1%. Goldman Sachs initiates coverage with a buy rating on Apple, saying the iPhone maker's growing installed base of users underpins the Apple as a service opportunity. That's pretty clear, but Goldman Sachs is a big name, so that should help the stock this morning. And then Rio Tinto down. This is really part of the fallout of the Chinese growth target being a disappointment because, of course, you want to watch commodities like iron ore for steel making, Dr. Copper, aluminum, oil, etc. on China. If they're not going to grow as much as you think, then we're not going to need they're not going to need as much of that stuff. So makers of that stuff are going to do poorly in today's session, and Rio Tinto is kind of a poster child of those makers. Anna, what do you see in Europe?
Yeah, I'll pick up on exactly that same theme then, Matt. Here we're kind of range-bound in Europe and drawing attention to Brent crude, moving for some of the same reasons as you highlight there with the Rio Tinto share price. The story out of China, the lackluster growth target of 5%, the fact that the economy wants to pivot away from maybe commodity reliance, more towards consumer-driven expenditure. And so that plays badly for Brent crude, it seems, down by 1.5%. Plays well for consumer products and services here in Europe, though. We see some of those French luxury names doing pretty well today, some of those up by more than 1%, and as a result, that sector goes a little higher. The net result of all of that, weakness for commodities in London, strength in Paris for the luxury goods sector, means that Stocks Europe 600 goes absolutely nowhere as we wait to hear from Jerome Powell and we wait for that jobs report later on this week. Here's an interesting one that we're keeping track of this week, though. Credit Suisse, of course, we have covered the travails, the twists and turns of the story around this particular Swiss lender for many, many months now. And the latest news is that we've seen one of their previously big backers, Harris Associates, deciding to sell all of their stake in the business. They still have the Saudi National Bank, so we'll be watching to see if we get any response there. But that's certainly some news flow that has put some downward pressure on the share price, even as it is not far from record lows, Matt.
All right, let's talk about the Chinese situation especially, but let's talk to Nobel Laureate Michael Spence right now. He's currently a senior advisor to General Atlantic and chairman of the firm's Global Growth Institute. Spence won his Nobel Prize for his theory of market signaling, and he has a warning for the post-pandemic world. Things are going to be different from now on. Michael, great to have you on the program. Thanks so much for joining us. I wonder if we can start with China, because, you know, we're so used to this economy being the engine for global growth. And now if they have a tepid forecast, after they've reopened, after they've ended COVID-0, a lot of people will be scratching their heads, like me. Why aren't we seeing a huge jump in the commodities that this engine needs? Are things going to be different?
Well, the Chinese certainly hope they're going to be different, and you touched on the reason a few moments ago. I mean, for the sustainability of their growth, they really need to manage this shift to a greater reliance on the consumer as a source of demand, avoid excessive activity in the construction area, and stabilize the real estate sector altogether. And so I think, you know, the growth may be pretty respectable. I think 5% is pretty good coming out of COVID. And it'd still be something of a growth engine for the global economy. But a knee-jerk reaction that they're going to go back and buy a ton of commodities, I think, is probably not right. And the markets are guessing that that's probably true.
I guess one of the biggest changes that I see in your notes in a post-pandemic world is something that we could see happening already before COVID hit, Michael, which is that the global population is aging, and it's pretty extreme. We have a lot more old people and far fewer young people. We're not reproducing at the same speed as we had previously been. What does that mean for our future, for Social Security, for taking care of, our parents and grandparents? How is this all going to look?
Well, it's one of several sort of secular trends that are distinctly non-transitory, that are restricting the supply side of the global economy. So, aging has occurred in countries that account for over 75% of the global economy. That's only a third of the global population, and those other economies, the young ones like India, may eventually get to a size that this trend is partially reversed. But basically, we have in some places a declining workforce. It adds to inflationary pressure because in the developed countries, people have pretty decent balance sheets. They stop working, labor force declines, they don't stop consuming, right? So you get an automatic mismatch relative to the past with respect to supply and demand. And then you have these fiscal pressures you're talking about. You have rising dependency ratios, the prospect that the young people are going to have, via the tax system, have to look after more old people. And there's lots of, unfunded liabilities lying around in this territory. So it's a big change. But when I think about it, I focus on the sort of the declining supply side elasticity that we got so used to over 3 or 4 decades in the global economy, when massive numbers of young people entered the global economy and became productive. So I think that's the main event.
Yeah. And Michael, yes, we often do think about the fiscal challenges and the tax base, but you're drawing our attention to the inflationary nature of these developments, which I think is interesting. And something else that I know that you study as a sort of long-term trend that could also be inflationary, decoupling and the future of globalization. You have for decades studied convergences and divergences across the economy. Where do you think we stand on the globalization and de-globalization thread now?
Well, we're obviously experiencing fragmentation, but I think the more important trend, which doesn't look like it'll reverse, is the global economy is subject to an increasing number of high frequency and fairly severe shocks, to the point that it's a macroeconomic event. And the response of the business community, particularly the people who operate global supply chains, but it also occurs in finance and in other areas, is diversify their sources. And that's backed up by increasingly, loud noises from the policymakers that this is the right thing to do. And I'm not saying it's the wrong thing to do. When you have shocks, you diversify to try to protect yourself, but that's expensive. I mean, you can see that in Europe. We're diversifying at pretty high speed away from, dependence on Russian fossil fuels, and that's not a cheap exercise. So it just adds more to the same. It raises the cost of doing business and contributes to a supply side move that doesn't help with the inflation fight.
And Michael, you make the point, obviously, that we've dealt with COVID in recent years. And one of the things that has happened as a result of that is something else is on the rise, and that is global debt levels, sovereign debt, your focus in particular. This obviously matters then if rates go higher, stay at elevated levels. What do you anticipate then on rates? Because this will have such a bearing on the ability of governments to pay back these debts.
Yeah, so I mean, we do have rising sovereign debt rates. This wasn't a mistake. I mean, it was part of the response to the pandemic, and it's a lot better than the alternative, which is leaving households and businesses, floundering around trying to survive. But we're over 100% sovereign debt to GDP ratio globally, and we're doing that in a rising interest rate environment. So you put your finger right on the important issue, Anna, which is, are we going into a rising interest rate environment that stays at elevated interest rates? That is, do we move to, after the inflation fight, to a new equilibrium in which the real rate of interest and a whole bunch of other interest rates are higher than what we were used to in this long deflationary period that we seem to be exiting? My best guess is yes. I mean, this is not an easy thing to determine, but when I add up the supply side constraints, I think that potential inflationary pressure is going to be persistent. And so I think we're in a rising interest rate environment that reduces fiscal space, and it makes all kinds of things challenging, including the climate change agenda, because that requires a ton of incremental investment.
I think it's a good point. It's the sea change that Howard Marks talks about now, a new regime of higher rates. I know you're an economist. Not giving investment advice, but I take from your comments that healthcare is one area we really need to focus on, right? If we're looking at an aging population, resources are going to go there. And then India seems to be another kind of golden opportunity if they're one of the big populations with the rising amount of young people.
Yeah, I mean, I think India, is a big economy. B, it probably has the highest potential growth rate in the world, among the major economies, just because of the stage it's at, per capita income, $3,000, big increases in the demand elasticity for things like cars and so on. I think India is looking promising. I mean, any country can have sort of disruptive events, sidetrack them for a bit. India had that in the second Congress term, before the BJP and Prime Minister Modi came to power. But I think the enthusiasm for India, look, I'm not commenting on whether markets have got the valuations exactly right. That's not something I'm great at. But I think in terms of potential, they have a dynamic, digital ecosystem. They had the geo-revolution, the mobile internet users have just had a startling rate of increase in the last 5 to 6 years. I mean, there's just a lot of pieces coming together. So on the India side, I'm on board.
Michael, thank you so much. Thanks for joining us. Nobel Laureate Michael Spence with us to talk about the direction for the global economy from here. Coming up, James Lord joins us, Global Head of FX and EM Strategy at Morgan Stanley. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Christian Horner, Red Bull Racing Team Principal. That conversation at 6:30 a.m. in New York, 11:30 a.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, the dollar's recovery from a 10-month low has run into a speed bump with the rally trailing behind the surge in Treasury yields. Joining us now is James Lord, Global Head of FX and EM Strategy at Morgan Stanley. And James, you know, the dollar is one asset that I think everyone pays attention to, has to pay attention to. Where do you think it's going? Because we had a pretty tremendous comeback from the lows, but it seems to have stalled out.
Yeah, absolutely. I mean, I think we're fairly range bound for the dollar in the very short term, but I actually think that the rebound in the dollar probably won't go much further from here in the medium term either. Actually, we're quite biased to move back towards a short dollar view for the remainder of 2023. And there are a few reasons for why. I mean, if you think back to like where the dollar came from over the October to January sell-off, this was a period of where, you know, everyone was quite optimistic about the rest of the world. China was doing well. Europe was performing well, and the US was we all thought was sort of slowing down. Now that narrative has changed a little bit, and the US is clearly doing much better than we all thought. But we're not going back to a world of US exceptionalism in our view, where, you know, the US data just accelerates further and further from here and leaves the rest of the world in the dust. Actually, you know, China, despite this morning's slightly softer GDP growth target that they announced, we think will grow much faster than that. Europe also doing very well. Rate differentials aren't really moving a great deal in the US's favor.
Okay, so range bound on the dollar and not really the rate differential story we were dealing with over the last few years. James, let me ask you about that Chinese story then. I know that you have a long on the Chinese currency. Where does that take us to? What's the thinking behind that?
Yeah, so we're bullish on the Chinese economy. We're expecting to see about 5.7% GDP growth for this year. I think we need to place that 5% target that was released this morning into a little bit of context. So that number was actually decided upon in the economic conference in December. And if you cast your mind back to December, economic conditions in China were very different to how they are now. This was a very early stage of the reopening in China, very unclear exactly how it would go. And I think it's understandable that there was a degree of caution in setting that GDP target in the way that they appear to have done. Now, you know, since December, actually the data have come in very strong. The reopening has gone extremely smoothly from a growth perspective, and I think actually in the end the GDP number will be much stronger. I think we may be looking at a similar story to what we saw in 2021, when they similarly also set a pretty conservative GDP target, and then the end result was significantly stronger than that target. So I think we should view this target rate of 5% as more of the sort of minimum rather than something that they're really aiming for.
We had a great big story over the weekend, James, about dollar scarcity that's causing real problems in EM. Is this a surprise to you, or you know, how quickly it's gotten this bad? Is it a concern to you going forward in emerging markets?
So, I mean, whenever the dollar's going up and US rates are repricing, there are always going to be some emerging markets that struggle in terms of their outlook. I mean, a lot of emerging markets do have high levels of debt, and refinancing that debt obviously becomes much more challenging in a world of high US rates. But I think if we look down the list of the broad range of EM currencies that there are, the countries that are really struggling are really more the exception than the norm, right? It's most EMs run pretty good external balance sheets, and you know, current account positions are in reasonably good shape. And I think if you look at how EM currencies have actually behaved in this cycle, you know, in total return terms and also even spot terms, ignoring the interest rate differentials, actually since the dollar started to rebound at the beginning of February, most EMs have done very well against the euro, done very well against the yen, done pretty well against sterling, and it's only really the dollar where there's been a bit of pressure coming through, and so that really tells you that this is a dollar story. This isn't really an emerging market story where you have real emerging market weakness. Okay. You know, as we say, like, yeah, we think China will do well, and that will spill over to the rest of the EM as well.
James, thank you very much. Thanks for joining us. James Lord of Morgan Stanley with his thoughts on FX markets. Later today, don't miss our exclusive interview with the JP Morgan Chairman and CEO, Jamie Dimon. That's at 11:40 a.m. in New York, 4:40 p.m. in London. This is Bloomberg.